$90 trillion. I want you to just stop everything you're doing and let that number sink in for a second. 90 trillion.
It's a number so big it almost loses its meaning, doesn't it? It sounds abstract.
It really does. It sounds like something from astronomy, not finance. But that is the estimated value locked up in U.S. Treasuries and the stock market right now.
Today.
It's this ocean of value that powers the global economy. And yet, for the most part, it's stuck. It's trapped in the pipes of the old world. We're talking about legacy databases, clearinghouses that close at 4 p.m., and settlement times that take days.
Exactly. It's a massive reservoir of capital, perhaps the largest in human history. But the plumbing attached to it is, frankly, archaic.
Archaic is the right word.
It's like trying to stream a 4K movie over a dial-up connection from 1995.
That is a perfect analogy. But today, we are talking about the plumber who is ripping out those rusty pipes and replacing them with fiber optics. We're doing a deep dive into Ondo Finance.
Oh, what a time to be talking about them.
Right. If you have been following the news, you know exactly why we are talking about them today, January 30th, 2026.
It has been a monumental week for them. Just a series of huge announcements.
Monumental is the word. We are looking at a total value locked, or TVL, that has just shattered the $2.5 billion mark. They've made massive moves onto the Solana network just days ago.
Yeah, that Solana news was big.
And frankly, the concept of Wall Street 2.0, it isn't just a marketing buzzword anymore. It feels like it's actually arriving.
It does. And that's really the mission of this deep dive today. We aren't just looking at Ondo as another, crypto project.
No.
If you look at the stack of research we have here, we've got investment guides from late 2025. The SEC reports the technical docs Ondo is positioning itself as a liquidity conduit.
A liquidity conduit. I like that.
They are building the bridge that allows that $90 trillion to flow into the blockchain economy.
And that distinction is key. This isn't about speculation, but sure, the token price moves, and we will get to that. But the underlying mechanics here are about structural change.
Deep structural change.
Imagine trading Apple stock or U.S. Treasuries at 3:00 a.m. on a Sunday with instant settlement, no brokers, from a laptop in Vietnam or Brazil. It sounds like sci-fi, but the sources are telling us this is happening right now.
It is happening right now. And to understand how and really why Ondo seems to be winning, we have to peel back the layers. We have to look at the tech, the regulation, which is a huge part of the story, and the products themselves.
So let's jump in. We have a massive stack of sources. Investment guides from Change Hero and CoinMarketCap, technical breakdowns of the Ondo Chain, and some very, very interesting regulatory updates regarding the SEC.
Yeah, that SEC stuff is a game changer.
Let's start with the basics, though. What is the actual problem Ondo is solving? Why do we need Wall Street 2.0? I mean, what is wrong with my regular brokerage account?
It's a fair question. And for most people, if you're a standard retail investor in the U.S., your brokerage app probably feels fine. You hit buy, the numbers change on your screen, and you feel like you own the stock.
Right, it feels instant.
It feels instant. But look under the hood. The traditional financial system, or TradFi, is built on friction. The biggest one is settlement time, often called T+1, or it used to be T+2.
T+1. Okay, so that means if I sell a stock on Monday, I don't actually get my cash until Tuesday.
Precisely. You don't have access to that cash. You are waiting days for trades to clear because the back end involves, a dozen intermediaries checking ledgers against each other. It's a series of databases talking to other databases, reconciling spreadsheets, essentially.
And it's not just the delay, it's the hours, right? Markets close.
The hours. Markets close at 4:00 p.m. They close on weekends. They close on holidays. Capital is essentially frozen for large chunks of time. If some major news breaks on a Friday night, you can't do anything about it until Monday morning.
And that's just in the U.S.
Right. If you go global, the barriers get huge. Geographic restrictions, high minimums, currency conversion fees. It is, by its nature, an exclusionary system.
Okay, so that's the old world. Compare that to DeFi.
Well, decentralized finance, DeFi, offers 204/7 liquidity. It's transparent, you can see the funds on the blockchain, and it's composable.
Composable, meaning you can plug different assets together like Lego bricks.
Exactly like Lego bricks. You can use one asset as collateral for a loan on another platform, all in the same transaction.
But DeFi has a branding problem, or maybe a reality problem. It's historically been high risk, volatile, and a bit of a wild west.
A huge reality problem.
Right.
And that is exactly the gap Ondo is filling. They are the institutional grade bridge. They aren't trying to replace the safety of Wall Street with the chaos of crypto.
Yeah.
They are trying to bring the safety of Wall Street onto the rails of crypto.
And the people running this aren't your typical anonymous coders, right? This isn't some project that spun up overnight.
Far from it. The founders, Nathan Allman and Pinku Sarana, are alumni of the Goldman Sachs digital assets team.
From Goldman.
From Goldman. And that pedigree is crucial to the whole story. They understand the old world rules. They didn't come to break the rules, they came to digitize them. They speak the language of compliance just as fluently as they speak the language of smart contracts.
Which is a very rare combination.
Extremely rare.
So what is the core mechanism here? How do they actually move a treasury bond onto the blockchain? Because I can't exactly shove a government bond into my USB port.
No, you can't. The term is tokenization. It sounds complex, but the concept is actually quite elegant.
Okay, break it down for us.
Ondo takes a real-world asset. Let's use a short-term U.S. Treasury bill as the example. They don't just, put it in a digital wallet. They buy the actual Treasury bill and hold it with a regulated custodian. In this case, they use giants like BNY Mellon or Clear Street.
So the physical, or at least the legal asset, is sitting safely in a bank vault, essentially. It's ring-fenced in the real world.
Exactly. It's off the table, completely secured by a trusted, regulated third party. And then they issue a digital token on the blockchain that represents a direct ownership claim on that asset.
So if I hold the token, I have a legal claim to the asset in the vault.
You have a legal claim, but because it's a token, you can move it, you can trade it, or use it as collateral instantly 24/7. It's decoupling the ownership from the legacy settlement rails.
And this brings us to what the sources call their compliance first moat. I find this fascinating because usually when we talk about crypto, compliance is the boring part. It's the homework. But for Ondo, it seems like their superpower.
It is their superpower, 100%. In the last few years, we've seen so many DeFi protocols crash and burn because they ignored regulations or tried to fight them.
Yeah, they tried the move fast and break things approach, and they broke things.
They broke things. Ondo went the other way. They aren't trying to be an anonymous protocol. They enforce strict KYC, know your customer, and AML anti-money laundering checks.
Which means not just anyone can mint these tokens. You have to prove who you are. You have to go through the onboarding process.
Right. And while that annoys the crypto purists who want total anonymity, it is the only reason institutional giants are willing to play ball.
That's the key.
BlackRock isn't going to put their assets on a chain if they don't know who is holding them on the other side. Because Ondo handles that compliance layer, it unlocks partnerships that other projects can only dream of. It's the ticket to the big leagues.
Okay, so that's the philosophy. Digitizing Wall Street rules so that Wall Street money can move at internet speed. Let's get into the actual products. They have a few, and they cater to very different audiences. The big one, the flagship for the big fish, is OUSG.
OUSG. It stands for Ondo Short-Term U.S. Government Treasuries. This is the product designed for qualified purchasers and institutions.
And qualified purchaser is legal speak for you have a lot of money.
Essentially, yes. We're talking about investors with at least $5 million in investments. So this isn't for the average retail trader, not directly anyway.
But what's fascinating about OUSG is its evolution. You mentioned this earlier. It tells the story of the whole industry. How so?
Well, when OUSG first launched, it was backed by a standard ETF, specifically BlackRock's SHV ETF. So Ondo would take investor money, go buy shares of this ETF on the open market, and then issue the tokens.
Sounds reasonable.
It was reasonable, but there was a problem. That ETF still traded on traditional market hours. It still had that T+1 settlement delay we talked about.
Ah, so they had a fast token, but it was tethered to a slow asset. It's like putting a rocket engine on a covered wagon.
That's a great visual. Exactly. There was a liquidity mismatch. If you wanted to redeem your OUSG on a Saturday, you couldn't. Ondo couldn't sell the underlying ETF shares because the stock market was closed.
So you're back to waiting until Monday morning.
You're back to square one.
Right.
But in 2024, they made a massive pivot, a really crucial one. They shifted the underlying assets into BlackRock's BIDL fund.
BUIDL. BUIDL. I love that BlackRock, this, $10 trillion asset manager, adopted the crypto spelling.
They know their audience. Stands for BlackRock USD Institutional Digital Liquidity. And this changed everything for OUSG.
Why? What's different about BUIDL?
Because the BUIDL fund itself is tokenized. It lives on chain. It allows for instant 24/7, 365 minting and redemption. There are no market hours for BUADL.
So by switching the backing asset to another on-chain, tokenized asset, OUSG became truly fast.
Precisely. It solved that liquidity mismatch. Now, an institution can move millions of dollars into or out of U.S. Treasuries on a Sunday night instantly. As of early 2026, OUSG has over $820 million in underlying treasury value. It's become a primary liquidity layer for institutions on-chain.
That is massive. But for the listeners who don't have $5 million lying around, let's talk about the product for the rest of us. Or, well, the rest of the world outside the U.S. Let's talk about USDY.
Right, USDY, or US dollar yield. If OUSG is for the institutions, USDY is for the broader market, specifically non-US investors.
Let's linger on that for a second. Why non-US? Why can't I get it here?
It comes down to U.S. securities laws. The SEC is very strict about offering yield-bearing products to U.S. retail investors. They classify it as a security. So to keep everything clean and compliant, Ondo offers USDY under Regulation S.
Which is a rule that specifically targets offshore investors.
Exactly. It's a well-established legal framework that lets them offer the product to the global market without running into trouble with U.S. regulators for their retail base.
Got it. So what exactly is USDY? Is it a stablecoin? It acts like one? It's pegged to the dollar?
It looks like a stablecoin, but it functions very differently under the hood. It's a really important distinction. Think about a standard stablecoin like USDC or USDT.
Okay.
When you give Circle or Tether your dollar, they put it in a reserve, usually Treasuries. That reserve earns interest because, well, interest rates are relatively high. Who keeps that interest?
They do. Circle and Tether keep the profit. That's their business model. You get the stable dollar, they get the yield.
Exactly. You get stability, they get the yield. USDY flips that, you hold the token and you get the yield. It's passed directly through to the token holder.
And what's that yield looking like right now?
It's currently paying somewhere between 3.69% and 5.2% APY, depending on rates.
That's a huge difference. Instead of my money sitting dead in a wallet, it's working for me. It's like a savings account on the blockchain.
That's the perfect way to think about it. And structurally, it's a tokenized note secured by U.S. Treasuries and bank deposits. And importantly, it's bankruptcy remote.
Bankruptcy remote. That sounds like a legal term I should really care about. What does that mean in plain English?
You definitely should care about it. It means the assets backing USDY are held in a separate legal entity, a special purpose vehicle, or SPV.
A separate company, basically.
A separate company with a very specific limited purpose. If Ondo Finance, as a company, were to go bankrupt tomorrow, the creditors of Ondo couldn't touch the assets backing USDY. Those assets belong to the token holders.
So even if the operator fails, the underlying assets are safe.
They're ring-fenced. It's a crucial safety feature that generic stablecoins don't always offer. It protects the user.
There is a quirk with USDY, though, right? Something about a lockup period. Saw this in the documentation.
Yes. This is a big one to understand. Because of that Regulation S compliance we mentioned, when you first mint or buy USDY directly from Ondo, there is a 40 to 50-day lockup period before you can transfer it on-chain.
Wow. That seems like a long time in crypto. 40 days is basically an eternity.
It is. It feels like a real drag. But it's the trade-off for compliance. It's a legal requirement to ensure the buyers are truly offshore. However, once that period is up, the token is fully liquid and transferable.
And does that apply if I just buy it on an exchange?
No. And this is key. For investors buying it on secondary markets, like a decentralized exchange, that lockup doesn't apply to them. They are buying seasoned tokens that have already gone through that initial period.
Okay, that makes sense. So we have OUSG for the whales, USDY for the global savers. But the newest development, and this is what has been all over the news in January 2026, is Ondo Global Markets.
This is the new frontier, phase 2 of their roadmap. They've conquered cash equivalents. Now they are going after the stock market.
We're talking tokenized stocks, Apple, Tesla, NVIDIA.
And ETFs like SPY and QQQ. Ondo Global Markets allows you to trade these U.S. securities on-chain 24/7. And the big news from January 21, 2026, just a few days ago, is the expansion to Solana.
Right. Why is the Solana expansion such a big deal? Why not just stay on Ethereum?
It's about accessibility and speed and cost. Solana is known for being high speed and having extremely low transaction fees, which attract a lot of retail trading volume.
The user experience is just faster and cheaper.
Way faster and cheaper. By putting tokenized stocks on Solana, Ondo is giving access to over 200 U.S. stocks to non-U.S. investors who might otherwise struggle to open a U.S. brokerage account. It's democratizing access.
And these tokens, they track the price exactly? Or is there some kind of lag?
They track it, but with a bonus. They are total return tokens.
Total return.
That means they reflect the price action plus any dividends. If Apple pays a dividend, that value is automatically reinvested into the token price. You don't have to manually manage it or worry about claiming it.
That is convenient. And what about liquidity? This is always my biggest fear with tokenized stocks. You get stuck with them because there's no buyer. If I buy $1 million of tokenized Tesla, can I sell it instantly?
That's where the conduit model comes in again. It's so smart. Ondo Global Markets isn't creating a separate, isolated market on chain. They use a mint and redeem model that taps into the liquidity of the traditional exchanges like NASDAQ and NYSE.
Unpack that for us. How does that actually work?
Okay, let's say you want to sell $10 million worth of tokenized Apple stock at 2 a.m. Ondo doesn't need to find a crypto buyer for that.
Right, there might not be one.
There might not be one. Instead, they take your tokens, and through their regulated broker-dealer partner, they place a sell order for the real shares on the NASDAQ. When the market opens and that order fills, they get the cash, and then deliver that cash to you on-chain as stablecoins.
So you're never relying solely on crypto liquidity. You're plugged into the main vein of global finance.
Exactly. You get the benefit of the deep multi-trillion-dollar liquidity of the traditional world, but with the accessibility of the on-chain world. And the volume speaks for itself. By late 2025, they were already seeing over $1 billion in monthly trading volume. It's growing fast.
That is incredible. So they have the products, but products need infrastructure. You can't just run this all on a spreadsheet. We need to talk about the tech stack, because Ondo isn't just issuing tokens. They are building their own blockchain.
This brings us to the Ondo Chain.
And my first question is why? Why does Ondo need its own blockchain? Isn't Ethereum enough? Or Solana? Why fragment the ecosystem?
It's a great question. Ethereum and Solana are fantastic public infrastructure. But for institutional finance, for that Wall Street 2.0 vision, they have limitations, mainly around identity and compliance.
Okay.
Ondo Chain is designed as a public permissioned blockchain.
Public permissioned. That sounds like an oxymoron. Can you clarify what that means?
It does, doesn't it? But here's the nuance. Public means public access. Anyone can trade on it. Anyone can build apps on it. You don't need permission to use the chain.
So it's open for business.
It's open for business. But the permissioned part applies to the security layer, the validators.
The people who are actually verifying the transactions and adding them to the chain.
Right. On a network like Ethereum, anyone with a computer and some ETH can be a validator. That's great for decentralization, but institutions worry about things like MEV, maximum extractable value, or front running.
Where validators can see your trade coming and basically jump the line to profit off of you.
Exactly. They manipulate transaction ordering. That's a non-starter for a serious financial institution.
So on Ondo Chain, who are the validators?
They are regulated institutions, broker-dealers, custodians, exchanges, entities that have a legal reputation to lose. They're not anonymous. This prevents front-running and ensures that the chain operates within regulatory guardrails.
That makes a lot of sense for a bank. They want to know that the person processing their billion-dollar transfer isn't some anonymous hacker in a basement.
Exactly. And there is an aha moment with the Ondo Chain architecture that I find fascinating. It's about what they use to secure the network. Typically, you stake the native token, right? You stake ETH to secure Ethereum.
Right. Proof of stake.
On Ondo Chain, validators can stake real-world assets.
Wait, say that again?
Instead of staking volatile crypto, they can stake tokenized treasuries like OUSG.
Wait, that's brilliant. So the security of the network is backed by the stability of U.S. government debt, not a volatile crypto asset.
It creates a much more stable security model, and it gives those institutions a reason to hold the assets. They can earn yield on the treasury and earn yield for securing the network.
It's like double dipping. A very clever economic loop.
A very clever and very stable economic loop.
Okay, now speaking of economic loops, we have to talk about Flux Finance. This came up a lot in the research. It's described as an on-chain repo market. I feel like repo market is one of those terms people hear on the news and nod along to, but don't actually know what it means.
You are absolutely right. The repo market or repurchase agreement market is the plumbing of the traditional financial system. It's the circulatory system.
The circulatory system. So it's important.
It's critically important. It's where banks and institutions lend cash to each other overnight in exchange for safe collateral, usually treasuries. It is a massive multi-trillion-dollar market that keeps global liquidity flowing.
And Flux Finance brings this to the blockchain.
Yes. Flux is a DeFi lending protocol. Technologically, it's a fork of Compound V2, so if you're familiar with that, it will look a lot like Compound or OV, but it has a specific twist.
What's the twist?
It allows OUSG holders, those institutions holding tokenized treasuries, to use those tokens as collateral to borrow stablecoins.
Okay, so let's walk through that. If I'm an institution and I have $100 million in OUSG earning 5%, but I need some quick cash, say $10 million for a trade, I don't have to sell the OUSG.
Exactly. You don't have to sell your yield-bearing asset. You just deposit the OUSG into Flux, borrow stablecoins against it, make your trade, and then pay back the loan. You keep earning your yield on the full $100 million in OUSG the whole time. It creates immense capital efficiency.
And on the other side, who is lending the stablecoins? Where does that money come from?
Anyone. This is the cool part. You or I can deposit USDC into Flux and earn a lending rate. And because the borrowers are posting over-collateralized U.S. Treasuries, it's a relatively safe lending environment compared to, say, lending against volatile meme coins.
So it connects the retail lender with the institutional borrower with a very safe asset in between.
Precisely. It's bridging the gap again. And a key detail here. While Ondo developed Flux, they sold it to the Neptune Foundation.
Why did they do that? Why give up control?
Decentralization and credibility. If Ondo controlled the asset, USG, and the lending protocol Flux, it would look a lot like a centralized bank.
It would be too vertically integrated.
Exactly. By spinning Flux off to an independent foundation governed by a DAO, they ensure the lending market is neutral and decentralized. It builds trust.
Smart move. Now, before we get to the tokenomics, which I know everyone is waiting for, we need to touch on how these assets move around. We mentioned Solana, Ethereum, Mantle, Say. How does $1 on Ethereum become $1 on Solana without getting lost or hacked?
This is the interoperability piece, and it's so important. Ondo uses something called the Ondo Bridge, which is powered by technology from Axelar and Layer 0. But they do something very specific to avoid the wrapping problem.
Wrapped assets. Okay, that's usually where the hacks happen, right? The bridge gets hacked, and the wrapped token becomes worthless because the real asset is gone.
Exactly. A wrapped asset is just an IOU from a bridge. If the bridge breaks, the IOU is just paper. Ondo uses a burn and mint mechanism instead.
How is that different?
When you move USDY from Ethereum to Solana, the bridge doesn't lock up your token on Ethereum and give you a copy on Solana. It actually destroys or burns the token on Ethereum.
It's gone from Ethereum.
It's gone, and then the bridge sends a message to the contract on Solana to issue or mint a brand new native token on Solana.
So there is no fake token. The token on Solana is just as real as the one on Ethereum was.
Correct. USDY is native on every chain it touches. It eliminates that bridge risk where the backing assets are stuck on one chain while the tokens are floating on another. It's a much safer architecture, especially for institutional money.
That feels like a prerequisite for Wall Street 2.0. You can't have billion-dollar hacks happening because a bridge had a bug.
Absolutely not. Security has to be the baseline.
All right, let's pivot to the token itself, the ONIGO token. We've talked about the products, OUSG, USDY, but those are stable-ish assets. ONIGO is the volatile governance token. What does it actually do?
Right now, its primary utility is governance. It controls the Ondo DAO. That means Ondo holders get to vote on parameters for Flux Finance, they control the treasury of the DAO, and they make decisions about the future direction of the protocol.
Governance tokens are pretty standard in DeFi. But is there more to it? What's the long-term vision for the token?
There is a lot of speculation about the future utility, especially with the Ondo Chain launching. It is very likely that Ondo will play a central role there. It could be used for validator incentives or potentially as a gas token, though that hasn't been finalized. But the market views Ondo as a bet on the ecosystem's growth.
Now, we have to address the elephant in the room. If you look at the charts, in January 2026, there was some volatility. And it links back to a specific date, January 18th, 2026.
The unlock.
Yeah. Walk us through this. What happened?
So early stage crypto projects usually have vesting schedules. Investors and the team have their tokens locked up so they can't just dump them on day one. It aligns incentives for the long term. On January 18th, 2026, a massive tranche of Ondo tokens unlocked. We're talking about 1.94 billion tokens.
That is a lot of supply hitting the market at once.
Yeah.
How much did that increase the circulating supply by?
It was a very significant increase. And basic economics tells us that if demand stays the same and supply spikes, the price goes down. We saw some short-term price pressure and a dip as the market absorbed those new tokens.
So is this a one-time thing? Or should investors be worried about next January too?
It's a known variable. This isn't a surprise. These unlocks are scheduled annually in January through 2029. It's all public in the vesting schedule.
Okay, so the market can price it in.
The market can and should price it in. And while it creates short-term headwinds, the expert take here is that it also increases liquidity. A token with a tiny float is easy to manipulate. A token with deep liquidity is more attractive to large institutional investors because they can build a position without moving the price too much.
So it's growing pains. Painful in the moment, but necessary for maturity.
Exactly. It's part of the process of becoming a mature, liquid asset.
Let's talk about valuation. This is where it gets tricky. People look at the revenue Ondo generates, the fees from OUSG and USDY, and then they look at the multi-billion-dollar valuation of the Ondo token. And the math doesn't always line up. The valuation seems really high compared to the fees.
This is a classic crypto valuation dilemma, and it's a very valid point. You have to apply option theory here.
Option theory.
The market isn't pricing Ondo based on the 0.15% management fee they're collecting today. If they were, the price would be much, much lower.
So what are they pricing it on? What is the bet?
They are pricing it as an option on the future infrastructure of global finance. The bet is that Ondo Chain truly becomes the backbone where trillions of dollars of securities settle. If that happens, the value capture opportunities are astronomical. You aren't buying a share of a mutual fund manager, you are buying a share of the next NASDAQ. That's the bet.
That makes sense. You're paying for the potential of becoming the plumbing for that $90 trillion we started with.
Right. And to justify that bet, you need to believe they can actually pull it off. Which brings us to the biggest risk factor for any crypto project: regulation.
This is usually the part of the show where we talk about lawsuits and Wells notices and, a lot of doom and gloom. But with Ondo, the news is actually good.
It's incredibly good. In fact, it might be the single most bullish signal in our entire stack of sources.
Okay, break it down. What happened in November 2025?
The SEC formally closed a 2-year investigation into Ondo Finance. And the key phrase here, the magic words, are without recommending charges.
That is the golden ticket.
It really is. In an industry where everyone from Coinbase to Uniswap has been fighting legal battles for years, getting a clean chit from the SEC is massive. It removes the existential cloud that hangs over so many other projects.
And for institutions, the BlackRocks and Goldmans of the world, that matters more than anything, doesn't it? They can't take on that kind of regulatory risk.
Absolutely. A compliance officer at a major bank is never going to approve a partnership with the protocol that is under active SEC investigation. It's just not worth the headache. Now that the investigation is closed, that barrier is gone. It allows institutions to partner with confidence.
And we're already seeing the fruits of that. Tell us about Oasis Pro. This happened right after the SEC news.
Perfect timing. Right after the SEC news dropped, Ondo announced an integration with Oasis Pro. And Oasis Pro is an SEC-registered broker-dealer.
So they bought a seat at the regulated table.
Effectively, yes. This integration is the crucial step that paves the way for Ondo to potentially offer these products to U.S. investors legally. Remember, right now, USDY is offshore only. If they can crack the U.S. retail market compliantly, the addressable market just explodes.
It's the final frontier for them.
It is.
And speaking of the big players, we keep mentioning BlackRock. We know OUSG uses BlackRock's fund. But what is the relationship there? Are they competitors? Partners?
Yeah.
Frenemies?
It's symbiotic. I think people worry that BlackRock will just build their own version of Ondo and crush them. But look at it from BlackRock's perspective.
Yeah.
They are an asset manager. Their goal is to gather assets under management, AUM. They don't necessarily want to build the messy, complex on-chain infrastructure, handle the smart contracts, bridge to Solana, manage the DeFi integrations. That's not their core business.
So Ondo is the distribution channel. They're the tech layer.
Exactly. Ondo acts as a major distribution channel for BlackRock's BUIDL fund. Ondo brings the crypto native users and liquidity. BlackRock brings the pristine, trusted asset. They aren't competitors, they are partners in a supply chain. BlackRock gets the AUM, Ondo gets the users and the on-chain activity.
That's a crucial distinction. Ondo is the last mile delivery for BlackRock's product.
Spot on.
So we've covered the what and the how. Let's look at the when and what's next. We are in January 2026. What is on the horizon for the rest of the year?
Well, immediately we have the Ondo Summit coming up on February 3, 2026 in New York.
Just a few days from now.
Yes, and expectations are high. Last year's summit was where they first announced the Ondo Chain. So the market is expecting some big news, new partnerships, possibly more details on that U.S. expansion strategy now that the SEC investigation is closed.
And looking at the broader roadmap, where are we? You mentioned phases.
Right. We are transitioning from phase 1 to phase 2. Phase 1 was cash equivalents, that's OUSG and USDY, that is largely done and scaling.
Yeah.
Phase 2 is public securities, that's Ondo Global Markets, the stocks and ETF. That is happening right now with the Solana launch. That's the current focus.
And phase 3, what comes after stocks?
Phase 3 is RWAs and beyond. This is where it gets really experimental and honestly exciting. We're talking about complex structured products, private credit, and utilizing the Ondo Chain as the settlement layer for everything.
Like what?
Imagine tokenizing a private equity fund or a piece of commercial real estate or even intellectual property rights and settling it all instantly on Ondo Chain. That's the long-term vision.
It sounds amazing, but I have to play devil's advocate. What can go wrong? We've painted a very rosy picture here. What are the risks?
There are 3 main buckets of risk, and they're all serious. First is competition.
Right.
Yes, BlackRock is a partner now, but Franklin Templeton is building their own tokenized fund on the Polygon and Stellar networks. The traditional giants could decide to vertically integrate and cut out the middleman like Ondo.
So Ondo has to run fast enough to become indispensable before the giants learn to sprint on-chain.
Exactly. They need to build a network effect that's too strong to displace. The second risk is regulatory reversal. We have a green light now, but laws change. Political winds shift. A new administration or a new SEC chair could take a harder stance on tokenization.
The clarity they have now isn't guaranteed forever.
Nothing is guaranteed. And the third risk, which is always present,
Smart contracts.
smart contract risk. We can never forget this in crypto. In the first half of 2025 alone, the broader RWA sector lost $14.6 million to exploits.
And that wasn't Ondo, to be clear.
Not Ondo specifically, no, but the sector. Code is written by humans, and humans make mistakes. If there is a bug in the Ondo bridge or the USDY contract, confidence evaporates overnight.
That $14.6 million figure is a sobering reminder. Even with all the audit stamps in the world, there is always non-zero risk.
Always. You can't audit your way to perfect security.
So let's wrap this up. We've unpacked a lot today. We have a protocol with over $2.5 billion in TVL. They are selling everything from U.S. Treasuries to Tesla stock on-chain. They have survived the SEC gauntlet. They are building what feels like the Amazon of finance.
It's an incredibly impressive position to be in at the start of 2026.
It feels like they are uniquely positioned to win this Wall Street 2.0 race. They've checked all the boxes.
They have, but I want to leave the listeners with a final thought. We spend a lot of time differentiating between traditional finance, TradFi, and DeFi. We treat them as 2 different worlds.
Right. It's suits versus hoodies. Wall Street versus crypto.
Exactly. But looking at what Ondo is doing, bridging the assets, bridging the compliance, bridging the liquidity, it raises a question for me. In 5 years, will that distinction even exist?
What do you mean?
Will we even say RWA or DeFi? Or will finance just mean on-chain finance? Because if capital flows to where it is most efficient, eventually everything ends up on the ledger. Ondo isn't betting on crypto replacing Wall Street.
They're betting on Wall Street becoming crypto.
They are betting on Wall Street becoming crypto, that the back end of finance will just be a series of blockchains.
That is a massive shift in perspective. It's not a takeover. It's an evolution, an absorption.
It's an absorption, and that's the multi-trillion-dollar question.
Well, on that note, we are going to sign off. Keep watching those charts, and more importantly, keep learning, because the financial ground is shifting beneath our feet. Thanks for listening to The Deep Dive.
See you next time.